And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show, the show where we bring you where the action is in the broader markets, and quite an active period. Last week, volatility was intense. We're going to get into all of that. Let's take a look at some of the news that drove price action last week. Now, we did see the markets soar on Wednesday after Trump pulled back on his tariffs. So that was certainly good news. Also, we did see interest rates remain quite high. We're going to get into that and talk about the impact there. And in other news, we did see today that China increased their tariffs 100 to 125%. And that sparked a rally in specific areas. Let's take a look at data that came out this week, and it was CPI and PPI, inflation-related data. Both numbers came in below estimates, but by and large, it was activity in the White House that drove major price action last week. And we also did see a couple of companies report earnings, and we'll talk about the impact there as well. I would say those were the two most elevated reasons that we saw different areas of the markets ebb and flow throughout the week. We are going to get into that as far as listing 8 specific items that were Trump announcement related and how they can look very much for the long term. Now, at this point in time, we are seeing Trump's handling of the tariffs. It is far and away not stable and not predictable, and that is not what the market's like. And this will evolve as we move through today's show. Also, the stock market currently has declined more than under any other president. And this is taking us back to the period when the Dow was first formulated in 1957. So lots of intensity out there, lots of volatility. Let's go ahead and unpack these markets. I'll share with you what I'm seeing. And as always, it's with an eye toward helping you navigate these tricky markets. So let's go ahead and take a look at that S&P 500 and see where did we close for the week. And here we are, a daily price chart of the S&P 500. And quite quickly, you can see the sharp sell-off going into Wednesday's announcement of the pushback on tariffs. That announcement did take place after the markets closed, and we got a very sharp rally on Thursday, actually on Wednesday, forgive me. And then we can see over the next 2 days, continued volatility, but net, the S&P 500 was up over 5.5%. Now, we did see the S&P find support at these April lows from last year. That's good news. We did see the markets bounce, and we closed just above this 10-day simple moving average. However, we're not seeing other characteristics that would signal a market bottom. And those are people that are subscribers to my twice weekly MEM Edge report, you will know exactly what we are on the lookout for to signal that it is okay to wade into these markets in any kind of a significant way. Let's take a look at the Nasdaq Composite, which got hit harder over this decline into a bear market period. And again, very similar. We can see this sharp gain in the markets on Wednesday. And we can also see that we are back above this 10-day simple moving average. And I would generally call this green shoots as far as creating a potential beginning of different areas beginning to shape up. We do have that RSI still in negative territory, and other factors also are at play when looking at these broader markets. What I did want to share with you, because we did get that very sharp bounce on the receding tariff news, and that was certainly good news, but I'm going to take us back to 2008 into 2009 as one of several examples I've been talking about in my report. And going back to the beginning stages of that 2008 into 2009 bear market, we did have significant rally days, such as a 10.8% advance in the beginning of November of 2008. And that was all about investors anticipating the Federal Reserve cutting interest rates. We did then from there experience a nice 5-day rally before pulling back. You will want to have a solid and sound system in place that's going to help you identify that true market bottom. To participate at this point in time, it's quite whippy in the markets. You want to keep your confidence intact so that when the markets turn very constructively and positively, you can then take advantage of the eventual rally out of this bear market phase. So from here, let's go ahead and take a look at these S&P 500 sectors. We're looking at a 2-month daily price chart view, and these sectors are sorted by that relative strength indicator in descending order. So quite simply, the S&P 500 is listed as the 5th area, and those that precede the S&P are relatively outperforming. So what we can see straight up is that staples and utilities remain at the forefront. These of course are defensive areas of the market. I will tell you they did underperform for the week. So when we look at this view, as you may know, those that watch regularly will know that it's not going to be a whippy move. The moves in and out of these various sectors are going to be more mild, but equally powerful as far as pointing you toward where strength is relative to weakness. So first up here, XLI, this is the industrial area. We can take a look, a very economically sensitive area. We can see this sharp move on Wednesday that is helping this particular sector come out of a pretty deeply oversold period. Airline stocks come to mind as one of the strongest areas, but we are going to be looking at some of these other areas in the industrial area that are beginning to shape up. Now, technology was top performing last week. I'll share with you where that strength is coming from. It was up over 8.5%, and yet another sector coming out of this oversold position. Unfortunately, that trend is still down, but there are bright spots within this tech sector, which I will share with you. At this point, it's all about getting that watch list really firmed up and keeping in front of these areas that are exhibiting strength that is above areas elsewhere. These are going to be your leadership groups that oftentimes go on to lead the markets once this downward pressure is lifted. So moving through, taking a look at some of these areas that are down here at this lower quartile. This is energy. We did see oil prices drop, all about economic uncertainty and the need for oil. Also, OPEC is working with the output levels, which is also reducing that price of oil. So we can see energy, after falling out of bed, remains in a confirmed downtrend. From here, let's go ahead and take a look beyond these sectors at ETFs that I've found to be very useful as far as keeping you on top of market shifts and movements. Again, that 2-month daily price chart view, RSI, and first up, we can see this is the yield on that 10-year Treasury. Huge gaps up. Several reasons for this advance in the yield of 10-year. The 30-year also is on the move higher. We're now sitting at about 4.45. And in essence, there are those that are calling that the bond market essentially collapsed last week because of these trade war and Trump tariffs, also because of an obscure basis point trade that a lot of hedge funds were leveraging their view and was close to a collapse there. So it has been implied that the Trump response, as far as his removal of those tariffs, or at least reducing them to 10% for most countries, was due to this collapse in the bond market. It was not looking good. There were comparisons to other periods where the Federal Reserve would have to come in to support these markets. So we now have the yield on that 10-year sitting up here at about 4.5, and that is elevated. So that is at some point going to dampen on the returns potential for certain areas. Also up here at the forefront, volatility. We had a huge spike in volatility. We closed the week here at about 40, which is quite elevated, even though we did have that spike, and that oftentimes precedes a rally. If we go back to the beginning of August, looking at that spike and how volatility closed on this particular day, we did see the markets subsequently rally. However, at this point in time, we are still elevated. So that is certainly of note there with that volatility. IGV, this is the software ETF. And this particular ETF was up about 7%. Again, that Wednesday rally, super strong, bit flat going beyond that. And there are select areas in software that I hope to get to as far as sharing them with you. Again, all about really understanding what is pushing some of these areas higher so that should market pressures be eliminated entirely, you can participate in those outperformers. Up here, XRT. Now, we did see retail stocks falter relative to the broader markets, up about 1.5% for the week. Next week, we will get retail sales data, so it could easily impact some of these names in that retail space, generally an underperformer, but up here at the forefront. One of the biggest sub-industry groupings last week, semiconductors, SOXX, the group was up over 9%. You can see this very sharp advance. We're going to take a look at a couple of names in this group. Most notable is, of course, Nvidia. Share with you the outlook here, there, and why that stock was up monumentally last week. Moving through these other industry groups, small caps are still struggling, and this is all about fears of an economic recession that tend to ebb and flow, but for the most part is widely viewed as a possibility unless we see these tariffs really level off and not be a potential impact going forward. So this is the Russell 2000 index, IWM, and it was up only about 1.2% for the week, essentially attempting to firm up after coming out of an oversold position, but we've seen these other rally periods, and overall, there's just not a lot of strength in these smaller cap names. Moving back, we'll take a look at one other area that when you look at the indexes and the performance of the underlying stocks in those, whether it's the Nasdaq or the S&P 500, the weakest names were biotech stocks. And IBB is the ITF here. It was negative for the week. And a lot of that having to do with these big biotech heavyweights that were down for the week. Amgen certainly is one of them. Gilead also remaining in a confirmed downtrend. Biogen is another large name. So overall, weakness in these riskier biotech names. Now, a lot of this can be circling back to the White House as far as biotechs faltering, as much as it is a riskier asset class. And it has a lot to do with headline news relating to R.F. Kennedy Jr.'s policy stance, and that is continuing to put downward pressure on these biotech names. Now, from here, I did want to share with you some areas that have been heavily impacted by Trump policies. This is something that I talked about in the beginning as far as that being the most overriding, impactful item on the market. So what I will do is share with you several headline news items throughout the week and then share with you their impact on these various areas. The reason is because their impact could be lasting and you will want to be aware of them. First up, Trump did announce that on the table and very likely to pass is a $1 trillion budget increase for the Defense Department, and that would not take place until 2026. However, it was enough to spark a move into those names. Also, Trump announced, as it relates to the current period, that the US needs more ships, which in turn is a really refined or defined area within those defense-related names. Let's take a look at a couple of stocks that jumped on the news. First up here is Huntington Ingalls, HII, had a gap up about 7% today, a push into positive territory with that RSI. The MACD never got into negative territory. My concern at this point is that we could find resistance at this downward trending 200-day simple moving average, which is sitting at about 221, and advance above that certainly would be quite constructive. Let's take a look at a couple of other defense-related stocks that have been on the move. First up here is Northrop Grumman. This is another name that only slightly pulled back. When you look at this stock relative to the broader markets, it held above its 50-day simple moving average. We now have a positive RSI and MACD. Last up, we'll take a look at RTX. This is Raytheon Technologies. It did get hit a bit harder, but you can see that we are in the throes of potentially closing back above this key 50-day simple moving average. If we can get that RSI up into positive territory and that MACD. Now, you may be wondering why I'm sharing constructive looking stocks. And it is for those of you that are more nimble, that are comfortable trading in a highly volatile period in the market. These are areas that are of interest as we go through. So let's take a look. Another news item relative to Trump is that he put a 25% tariff on vehicles that are imported to the US. Now, a couple of items here as far as what took shape. We did see moves such as General Motors decline for the week, but on the bullish side, we're continuing to see those auto parts suppliers, as it's anticipated that individuals will keep their vehicles for longer. This is a ZO in the throes of a potential V-shaped recovery. We do now have that RSI in positive territory, that MACD also sitting up there in positive territory. Another name, CPRT, again in that auto parts industry, and we can see it's quite a bit more advanced as far as now above each of these key moving averages. Of interest here as well is the fact, unlike many stocks, in fact most stocks in the market, we do now have an upward trending 10 and 21-day simple moving average. When these shorter term moving averages close above longer term moving averages, that is known as a golden cross. It's a secondary indicator, but certainly constructive, obviously relative to what else we are seeing out there in the markets. Last up here is the fact that today the stock broke out of a 1 month, or actually 6-week base, and we can see that MACD now up here in positive territory with that RSI. Moving on, another Trump announcement and related to the markets is the fact that today Trump did increase China tariffs so that we are now sitting at that 145% level. Let's take a look at the biggest move in response to this. This is all about a safe haven trade of increased trade war. GLD is that S&P Gold Shares ETF. We can also take a look at any number of underlying gold stocks, such as AU, Anglogold. We can see this gap up. We are most certainly in an oversold position, but super high volume on that. And there are many Wall Street analysts that are anticipating a move higher that could be lengthy in these gold stocks due to reasons beyond the safe haven, but certainly after a 27% gain, I wouldn't suggest chasing it. Let's take a look at some of these other names that are in that gold space that experienced sharp gains this week. Newmont, on the verge of a potential base breakout of a lengthy nature. We're going to take a quick look at the weekly on NEM. Again, big sharp advance here, but we are just now on that weekly getting that MACD into positive territory. Now, as far as looking at precedents, this is something I'm going to be doing in my report over the weekend. When these names experience these sharp gains, what to be on the lookout for in the immediate future. But as noted, longer term, many of these names are setting up quite nicely. Harmony is another one, same dynamics with those creasing gaps up on a daily basis with high volume. Last up, AEM is another name that is also experiencing a gap up and is now sitting up here at a new high in price. So that certainly was a policy relating to that safe haven trade, given the fact that the trade war with China is continuing to be intensified. Also, what we can see, another order, executive order that came in, is that Trump last week signed an executive order that is going to allow coal-fired power plants to continue to operate for at least 2 years. And he cited the need for AI-related power, and that was one of the reasons. So we did see a couple of names in the utility space that responded quite bullishly to that. BRKB was up for other reasons as well. And we can see this is that Berkshire Hathaway fund. And they do have a subsidiary fund. The company actually owns 12 coal-fired power plants, and they are set up to advance, or certainly be able to take advantage of this new ruling. As noted, there are other heavyweight names in this fund that are also faring well, but we can see that it's back above that 21-day simple moving average, positive RSI. And then another coal-fired plant is Duke. They have several as well. DUK is the ticker symbol, and we can see similar price action where we did get down very close to that 200-day simple moving average. We're close to moving back above these shorter term moving averages with a bullish RSI. Another item that came to light this week, not necessarily Trump signing any particular executive order, but there was a study that came out that talked about tourism and the fact that it has plummeted in the US as far as the number of people coming to visit. And a couple of names that we can take a look at here. Delta Airlines remains in a very confirmed downtrend. They did report earnings this week, had this move higher, but subsequent to that is very much remaining in a confirmed downtrend. We can take a look at United Airlines. They are due to report earnings next week. Again, we did have that tariff relief rally, but net still very much in a downtrend. And then certainly from here, you can take a look at any number of hotel related stocks that are also deep in downtrends. This is Marriott as an example. So moving through some of these other items from last week, let's take a look at Nvidia. I mentioned to you that semiconductor stocks were on the move higher. Actually, I will begin with another view of this SOXX. This is the semiconductor ETF, and you can see, as mentioned, that the stock had a very sharp advance here. It, in fact, was coming off of being down 33% from its recent peak in price. So really oversold bounce. But when we talk about names such as Nvidia, it's going to get more refined as to why this stock was up so much last week. And in particular, Nvidia was up 17.5% for the week, but on Wednesday, it gapped up 19%. And this was all about the CEO of Nvidia attending a dinner with Trump at the White House. And at that time, Trump did signal that he would pause the tariffs that were being put onto sales of semiconductor chips from Nvidia to China. So that was one of the reasons for this sharp advance higher. Let's take a look at this technical area as far as this market and Nvidia in particular. What I wanted to highlight for those of you that would be fearful that you missed the move. We did see the RSI is still in negative territory, and we still have downward trending longer term moving averages. Now, this is going to dampen the potential sharp reversal that appears to be in place. We did get that MACD crossover. Good news there. We closed below that 21-day simple moving average, but most definitely we still have work to do. This is another stock that I am going to review very closely as far as the prospects near and longer term in my MEM Edge report. So that is that fact that we did see Trump's actions, his announcements really impact these broader markets. And then also last up, I'll take a quick look with you here at some of the companies that reported earnings, because surprisingly or not, that is another area of names that are not only impacting those companies that come out with earnings, but it's impacting peer stocks. So first up here is Morgan Stanley, and the company did report earnings above estimates. And one of the main reasons is because they saw a very sharp increase in equity trading in Q1. So in turn, talking about moves in names that would also benefit from that, we can take a look at some of these other stocks that are trading related. They provide platforms for institutions to trade. First up here is IBKR. This was a big winner for us back here. And the company is renowned for their advances as far as technically being able to trade. We can see this move back above the 21-day simple moving average. We're not quite in bullish territory yet, but it is firming up. MKTX is another firm very similar, and it has quite a bit more work to do, but it is signaling how these earnings can impact other areas. Let's take a look at KMX. This was a stock that had advanced going into their earnings, quite simply because they do have used vehicles. There's anticipation that sales in used vehicles will increase under the 25% tariff. However, the stock gapped down in response, and that was all about the company coming in with earnings that were below estimates. And in turn, we did see Carvana and other related names falter. Also on that earnings front, we can take a look at CLM. This is Cal-Maine. They are involved in the producing and selling of eggs. As many of you know, the price of eggs has skyrocketed and the company benefit. They had huge earnings in Q1. Now we have seen egg prices pull back, and we can see CALM close the day back above that 50-day simple moving average with a positive RSI and MACD. And that is it for this week. Of note is the fact that next week earnings season is going to pick up rather considerably. We have Netflix due to report their numbers, always a big market mover. Goldman Sachs also will be reporting, and then Taiwan Semi, TSM, a major semiconductor now company. Those are a few of just many that are going to be reported, other large banks, Citibank among them. So you will want to have that in the back of your mind. Have a great weekend. I'll look for you here again next Friday.